Alright, you need to see this. Analysts just issued new warnings. Massive volatility is coming to both Bitcoin and the stock market. And this comes right before three crucial pieces of data that could trigger sharp moves. In fact, on October 2025, we have three key reports that could shape the last half of 2025, so let us break down exactly what these are, what we can expect from each, and how this could play out for both traders and investors alike. Before we start, quick reminder, if you hold crypto, stocks, or any leverages, this video is for you. I dig through the macro calendars so you don't get blindsided. So we'll use the latest forecasts and market models, not hype, so you can trade, hedge, or hold with confidence. But first, let me show you what we're watching. First, we have Core PCE. This is the Fed's favorite inflation gauge. Markets expect the Core PCE to sit near 2.9% year over year for the recent month. Second, we have the US GDP prints. Markets are pricing in around 2% annualized growth. Third, we have weekly initial jobless claims. Economists expect another modest increase. Now these three reports alone can move the markets, especially in this current environment. So let's review the upcoming schedule. As you can see, Core PCE report is actually tomorrow. Then we have the third quarter GDP estimate revision on Thursday, and then Friday we have the weekly initial jobless claims report. Now, every one of these events can shift market expectations and asset prices because of how close they are to the November FOMC meeting. Now listen closely. The Fed is still expected to hike once more in this cycle. In fact, CME Group's FedWatch shows a 93 probability of a 25 basis point rate hike in November. But each of these releases can skew expectations of where the terminal rate sits, how soon they might pause after November, and how the economy is holding up amid the recent tightening. Remember, the Fed makes policy decisions based off real-time data. So these three releases will offer the most up-to-date snapshot of the labor market, spending patterns, and GDP growth. Here's what we know. First, Core PCE. Well, according to a note by economists at ANZ Research, it's clear that inflation continues to run hotter than expected, meaning there's upward risks to their forecasts. They go on to say inflation excluding shelter remains sticky and suggests underlying price pressures remain. It is worth noting that most of the stickiness is outside of rents, suggesting that nominal wages are also contributing to limiting disinflation. In other words, even if rents stabilize, the Fed would still have to see wage growth slow to really feel confident about disinflation. The good news is that most economists agree that the recent data prints are lagging, and that's mostly due to two factors. Number one, the pass-through effects of tariffs haven't fully worked their way through the economy yet. Just think of all the goods we consume that are produced overseas. When input costs rise from tariffs, those costs typically get passed on to consumers. However, many companies chose to absorb those costs instead of passing them along. Now that inventory levels are shrinking, companies no longer have a choice but to pass along those higher input costs to consumers. Second, the recent supply shocks caused by extreme weather are now starting to feed into consumer prices. For example, produce prices are jumping thanks to the bad weather plaguing the West. The bottom line, economists are expecting a hot inflation print tomorrow, and the market isn't fully pricing that in yet. And when the data comes in hotter than expected, we should expect an immediate repricing of rate expectations. Meaning traders will push out the rate cut expectations and push up the terminal rate, which leads us to our second catalyst, the GDP prints. According to a note by the folks at Oppenheimer, the market is pricing in only a 50 chance of the Fed cutting rates by year-end. But we think the odds of a December rate cut are closer to 80. In fact, in his latest speech, Fed Chair Powell said that recent indicators suggest economic activity and spending have softened from the strong pace seen in the first half of the year. So what does that mean? Well, if the data continues to soften, the market will price in a faster rate cut. And if the data stays strong, the market will price in slower rate cuts, which means the entire rate cut schedule could get pushed further down the line. So how do we know if the economy is slowing or staying strong? Well, Friday's jobs report was a bit of a mess, but overall, the trend of softening labor demand is intact. And that leaves us with initial jobless claims. Every Wednesday, we get a flood of data on employment from various sources, and almost all of them tell the same story. Labor demand is cooling, layoffs are rising, consumer spending is slowing, and job openings are falling. If that sounds like a recipe for a recession, that's because it is. But here's the thing, the Fed wants to see labor demand cool. That's what they've been trying to do this whole time. Soft landing, anyone? Well, maybe, but the impact of all three of these reports will depend on how much of a surprise they are. And the bigger the surprise, the more likely we see volatility. Let me explain. First, if core PCE comes in hotter than expected, everyone will be focused on how this affects the terminal rate. Will it be 5.5%, 5.75%, or even 6%? The answer depends on the magnitude of the beat. If it's only a slight nudge higher, this will be bullish for the dollar and negative for stocks. On the flip side, if it comes in with a substantial upwards surprise, the dollar could spike higher and risk assets could plummet. Think double whammy, right? Second, if GDP comes in worse than expected, everyone will be focused on when the Fed will cut rates. Is a December cut now off the table? Will the market push the first cut into early 2026? And will the stock market rally on the prospect of easier monetary policy? Again, the magnitude of the miss matters. A small miss won't really change much, but a large miss will shake the markets up. Third, if initial jobless claims come in better than expected, the narrative will immediately shift to the Fed needing to keep policy tight for longer. We could see rate cut baits pushed back, bond yields spike, and stocks fall. Again, the magnitude of the beat matters. A small beat won't really change much, but a large beat will likely spook the markets. Okay, so what does this all mean? Well, simply put, the biggest risks for the next week will be on days when we have major macro prints. And this is precisely what happened in September. On the day of the FOMC meeting, Bitcoin fell sharply, dropping 11% in a single day. And looking back, this move seems to have been triggered by the stronger than expected non-farm payroll report that we got on the first of the month. So in terms of positioning, I recommend pre-sizing. You don't want to be making adjustments on the day of the event. Instead, prepare ahead of time. Alright, let's dive into the playbook and talk numbers. Here are some concrete examples. First, if you're exposed to the markets and you want to protect your positions, look into buying put spreads or contracts. These options give you the right to sell Bitcoin at a certain price. Let's say you own 10 Bitcoin and you want to limit potential losses to $25,000. You could buy one contract that allows you to sell Bitcoin at $30,000 for 10 Bitcoin. If the price drops below $30,000, you'd lock in $300,000 and avoid a total loss. Now, remember, options aren't free. You'll pay a premium for this protection, but you'll have peace of mind knowing that you're covered. If you're interested in learning more about options strategies, leave a comment below and I'll drop a guide in the pinned comment. Second, if you're in crypto and want to take a more neutral stance, look into buying strangles. Strangles involve buying both call and put options with different strike prices. This strategy thrives when the market makes big moves in either direction. Since you're hedging both sides, you'll collect premiums on both. Third, if you prefer cash and stablecoins, well, this is an easy one. Simply wait for the markets to fall sharply and buy the dip. Finally, monitor correlations. If the dollar spikes, expect risk-off moves. If yields suddenly drop, brace for risk-on action. Look, the goal here is to stay nimble and proactive. Don't fight the Fed and don't panic. Take steps before the volatility hits and make sure you're ready for whatever comes your way. And hey, if you want to see the exact numbers behind these trades, hit the subscribe button and I'll drop a free PDF in the pinned comment. Now drop in the comments. Are you bearish or bullish into Core PCE Day? I'll read and reply to the best answers. And share this video with someone who trades stocks or crypto. This week will be wild. See you tomorrow.